What is happening with these markets today, and does it have to do with the incoming Fed meeting? That's what we're going to try to uncover here on Macro Money on a day when stock markets seem to be retreating. I'm Ilya Spivak, head of Global Macro here at tastylive. And as ever, we'll start, as we do always on Mondays, with a look at how last week fared and what that price action seemed to be suggesting, and then try to figure out from there what may be coming next. We start the week here with sort of interesting bout of weakness, and a bout of weakness that seems to contrast quite a bit with what we saw last week. So let's begin our conversation there. Here's the performance last week, and we can see there is the reference point there of that Thanksgiving week recovery. And last week, momentum plainly fizzles. S&P 500 up just 0.3% on the week, so call it pretty much flat. NASDAQ does a little bit better, a 1% gain there, but of course, nothing like the almost 5% gain from the prior week. And we see that all of this is happening against the backdrop of yields edging higher. The 10-year up 3%, the 2-year up 1.9%. So yields ostensibly finding more support at the long end of the curve. We'll take a look at why that might be the case momentarily. Crude oil edges up, but again, it continues to broadly slide. Last week was something of a wiggle in that story. But the general sort of trajectory for crude oil continues to be this stubborn but incredibly annoyingly slow decline. I say annoyingly because, of course, I'm a little bit short. And while it's moving in the way that position would want it to move, this thing is like watching paint dry. It's very, very slow. And despite the fact that we have a little bit of an uptick last week, it ultimately doesn't alter the trajectory, but nor does it make enough headway to really get anybody, certainly me, excited while sitting on the short side. So crude oil seemingly still off on its own, figuring out its own thing. Gold doesn't do anything. It stalls, which seems to jive with what's going on the yields side of things, as well as what's happening with equities. Of course, the prior week, we had strong showings for gold and for stocks and for Bitcoin and for currencies not called the US dollar, with, of course, the exception of the yen, where things are kind of doing their own thing in and around the fiscal policy plans of new Japanese Prime Minister Takaishi Sanae. But what we looking at this week is, again, across all those assets, a fizzle, seemingly, because just as stocks ran out of juice last week, so too did gold. Euro slowed down meaningfully as a kind of avatar for general dollar performance. The yen did a little bit better, up 0.5%, but only just. And Bitcoin lost any pretensions to a kind of risk-on signal, down 1.6%. Now, that, of course, is nothing like a big move, especially in Bitcoin terms. But nevertheless, we're looking at a situation here where if there was a risk-on move that was finding follow-through last week, Bitcoin seems like a natural place where it would occur. And while stocks ultimately, and somewhat belatedly, Friday was really the day when they found a little bit of a lasting bid, while they managed to get a little bit of upside momentum, finally, it never really came together for Bitcoin, and it finished the week on the defensive. So looking at all of this together, it seems like what we have here this week is some level of concern about what is coming next. What is that thing that's coming next? Well, shock of shocks. If we look at the economic calendar here, it's pretty one-sided. We've already had the big news for the first day here. That was the trade figures out of China. Not really anything to write home about there. A little bit better on the exports side of things, a little bit softer on the import side of things. And of course, that's the much bigger story, because the issue in China has not been a problem with exports. The issue in China has been a lack of demand domestically and the inability of the economy to pull itself out of essentially economy-wide deflation for the better part of 2 years at this point. And so even a little bit over. And so the issue really doesn't see meaningful progress here. It's domestic demand that we're looking for in China to really right the ship. And against expectations for a 2.8% rise in imports, we get 1.9. Exports, of course, do better, 5.9 versus 3.8 expected, but exports is not the kind of thing that one could really bet on here to power China's economy, because, of course, the problem with that is most of China's external markets of size are in some level of dispute with it. And, of course, the United States is first and foremost there, but it's not as though the big, rich economies of Western Europe are too far away from where the U.S. is in terms of wanting to push back against some of China's policies. So, and of course, there's concern on both fronts about dumping of cheap Chinese goods on foreign markets. Why? Because they're not selling at home, because domestic demand is anemic, hence the import numbers. So we're looking at a situation here in China that isn't particularly encouraging, no matter what that export number says. And in fact, that export number is in large part a consequence of dumping cheap overstock inventory wherever it might get sucked up and at steep discount. So that's not exactly a vision of the solution. It's a symptom of the problem that exports look the way they do. When we look at the rest of the week, the focus clearly seems to be on Wednesday's policy announcement from the Fed, and there's not really very much else on the board to really capture the market's attention. Speaking of China, we are going to get their inflation numbers on Wednesday. That'll probably be an afterthought for folks as they're really focused on the Fed. And we might get some JOLTS numbers this week. This is the job openings report. It's always a little bit sluggish relative to other indicators, but here we might get September's numbers, might get October's numbers. We'll see if those numbers actually come out and whether they change anything about the Fed calculus. They're so stale at this point, it seems unlikely that they're really going to make a dent. We did see a very interesting bit of data coming out of last week on Friday. The consumer confidence report ended up registering much stronger than expected. In particular, it seems like we got a very healthy uplift here for the expectations index. So it would seem that the general sort of state of the U.S. consumer is meaningfully better than anticipated. This would be the strongest reading that we've had since August. So for whatever reason here, the U.S. consumer is feeling themselves a little bit more optimistic about where things are going rather than where things have been and where things are. Perhaps that is because the one-year inflation expectation dipped down to 4.1%. Now, it has been dipping going back to August steadily, month in, month out from August onward. This would be the fifth consecutive month that it's come down. But now it's come down to 4.1%, which is the lowest that we've seen it since January of this year. So we saw, of course, that we got as low as 2.6%. Here is January right here. That's about 3.3. And so this run up here, this is the tariff scare. And where we've arrived now seems to be something like an attempted turn. But is it? We'll have to see. Because what we've seen for the past, let's call it 4 months before this latest data, is that inflation expectations have been cooling and sentiment couldn't really find a bottom. We get a tenuous little rebound here as we shift down to 4.1%, but we'll see if that ends up being a lasting sort of thing. And of course, that's a major consideration because, so we can clearly surmise here, going all the way back to the 1950s and even a little bit before, consumption is give or take 60 to 70 odd percent of the economy. So all this other things, exports, imports, government spending, all those things that we are constantly talking about being disrupted by, whether it's the tariffs, whether it's government job cuts and the shutdown. All of that is relatively small potatoes compared to household consumption, leading everything else by a long mile. So if consumer confidence is relatively well supported, then we don't really have an economy that's looking like it's in some sort of dire straits and searching for support, whether it's from fiscal or monetary authorities. We also got the updated numbers for U.S. PCE inflation. Again, very, very stale. 2.8% on both core and headline is where we land there. This is the Fed's favorite inflation gauge. We can see here they both sort of arrive at 2.8%. No big surprise there. And of course, this data is so stale that at this point, does it even really enter into the Fed's calculus? Maybe not. And so with that in mind, it doesn't really seem like that makes that much of a difference. What we can see, and this is going back to the ISM data that we got last week as a kind of touch point for where the economy is, we have a service sector that's still keeping everything afloat. We can see it accelerated a little bit in the latest data here. And as ever, this is in the logic of PMIs. So above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So we can see the manufacturing sector contracted a little bit more than expected. It was expected to contract for what it's worth, but we ended up with 48.2 versus 48.6, so a little bit faster on the contraction, but also a little bit faster on the expansion for services than expected. So the economy seems to be holding up reasonably well at this point. Of course, we are looking at things that are still kind of within familiar ranges. We're not really making any huge strides here, but it appears to be that we're looking at a situation where, at the very least, if the market thought that there was urgency to cutting rates, that is not seemingly what is on display here. And so with that in mind, we seem to be looking at a situation where the picture appears to be telling us that what we're seeing is not the kind of thing where the markets would be essentially treated to a validation of their kind of hopes for the Fed this week. And perhaps that's why, when we look at the way that the markets performed today, coming out of the weekend, we see what we see, which is, for the most part, soggy. S&P down, NASDAQ down, yields up, the dollar a little bit stronger, gold at best idling. And that's despite the fact that when we look at the makeup of these same ISM numbers, what we end up seeing is employment, the Fed's sort of stated reason why they're looking to cut, still in contraction mode across both services and manufacturing here. It's this part that seems to really take center stage, and this is the prices component, which, although it's cooled off some, looks still relatively elevated compared with history. And so, for what it's worth, the expectation that the markets have for this week looks like an 89.4% chance that what the Fed will do this week is cut. And at this point, that seems hardly like a controversial statement. If we take a look at the way that this has evolved over recent days here, we can see we've got today actually a little bit firmer on the likelihood that the Fed is going to cut right here, but we've been over 80% as of the end of last week and even a week ago. So it's not like this is anything that the markets didn't already know. The larger issue seems to be whatever is going on at the long end and what that seems to be saying about where we go from there. Because if we take a look at this chart that we like to go back to that's telling us what's going on beyond this year, we can see not really a whole lot going on for 2025 at this point. Again, things are anchored. But for next year, we've shifted significantly. At the end of last week, we were closer to 74 basis points in aggregate because we were at about 64 basis points for next year. That is to say, we were looking at least 2 cuts with a strong possibility for a third. In fact, on Friday, we closed at 66 basis points for next year. So that's 16 basis points in the direction of a third 25 basis point cut after the first 50 basis points. That's 2 cuts there. So that's a 64% chance that you get a third cut. What a difference the weekend makes here, apparently, because now we're at 52 basis points, barely priced in for 2. Now, maybe that's why we're seeing yields higher today, especially at the long end. Maybe that's why we're seeing the dollar stronger. Maybe that's why stocks are off, because it seems like the markets might be pre-positioning for the Fed to be something of a letdown, not so much on the cut itself, but on the outlook. In September, we can see the Fed was looking for just 1 rate cut in 2026. They went down from 3.6 to 3.4 on the outlook. 3.6, incidentally, is 3 cuts this year, which it looks like the Fed is going to validate. So at this point, that side of the story is kind of foregone conclusion to a level where it's not really something you'd expect to be driving speculative interest. But next year clearly is a major disconnect. And we're not that far from being in next year. So this is now front and center, and one might argue has been front and center, if not for the Fed's October rug pull. More on that momentarily. But what we end up with then is a situation where the bogey is next year's outlook. The Fed only said 25 basis points for that whole year. The markets were at 3 cuts leaning going into it. Now that the Fed is immediately in front of us, they seem to have backed up and said, hold on. Let's not over-speculate, lest the rug get pulled violently from under our feet yet again. And so that seems to be the main thing for us to look at this week. What will the Fed write down on the December edition of this table? Will it give the markets the 50 basis points that they've now baked in? And if they don't, then is there really any room for sentiment not to take some heat? Because if we consider Fed goes to 50 basis points, something that they're ostensibly reluctant to do, then that's already priced in. There's not much to do there. If the Fed goes to 3, okay, yes, the market might have a positive response. But how likely are they to go to 3 when they seem to be reluctant to go to 2? Why are they reluctant to go to 2? Well, recall what happened in October. This was the cut in October. That was also the top in the S&P. Why? Because the Fed chair came out and said, you all seem to think that December's rate cut is a foregone conclusion. Well, let me disabuse you of that notion. It is not, and far from it. Because we thought September and October were going to be maintenance cuts around signs of perhaps some sogginess in the labor market in the summer period. December is not that. And we don't have the data to really know where we are. Now, if something were to go terribly wrong in the economy, we'd see it because we'd see it in the bond yields, we'd see it in the dollar, we'd see it in the price response. But absent a crisis, how are you supposed to forecast when all the government data is still trying to backfill? For example, JOLTS is still trying to backfill from September. How in the world is the Fed supposed to look at this and say, yes, we know where this is starting to trend in a forward-looking way? Very tough to do without good quality data. And so, to paraphrase Powell, what do you do when you are driving in the fog? You slow down. So the Fed seems reluctant to overpromise. And that would suggest that already committing to anything more than one cut might be something of a lively debate. Looking at the minutes from October's meeting, a bunch of policymakers were concerned about embedding inflation expectations, and a bunch wanted to not cut rates that month, and certainly didn't think that it was appropriate to go again in December. Now, of course, there was also the Dovish contingent, in particular folks like Stephen Mirren, who wanted to embrace every rate cut in size and who seemingly want to be doing easing in 50 basis point clips for the next several meetings because they see rates much lower than they currently are. And that's certainly there, but it's also not the consensus, nor is it the majority view. And so the Fed might be reluctant to do all that and to over-commit to easing next year. Now, the market seems to think that if they do 50, that can be baseline. But if they end up at 25 basis points still, and the rationale ends up being we have to take it meeting by meeting, we don't want to paint ourselves into a corner, we just don't know, that probably looks like disappointment. And this stalling in the stock market around the outlook becoming less dovish, that might give us another leg lower from very familiar levels here, right around 6,900, where the Fed seemed to inspire the break lower after last month's meeting. The dollar, for its part, seems to be stabilizing here a little bit after this pullback. And interestingly enough, this most recent pullback happened even as the outlook became a little bit less dovish. We'll see if this continues to move here, but the dollar seems to have been increasingly a creature of risk aversion rather than a creature of yields. And so if that's going to be how this goes, well, then we're perhaps looking at a situation here where we have a Fed that, in sort of disappointing the markets on the rate cuts math, ends up with a situation where they drive the dollar higher, not because yields are this or that in the wake of the policy announcement, but because there's risk aversion and capital goes to cash. And the cash of choice ends up being the US dollar yet again. Now, from a positioning perspective, in terms of what I'm doing with all of this information and all of this stuff, I've trimmed back my bond exposure. It seemed to be like ZB was starting to break to the downside here today. So I took off my TLT exposure. I might put it right back on if the Fed ends up being a catalyst for that to anchor here. But the price action was getting a little bit saucy, and so I decided to step back here and wait. I'm still long a little bit of gold, which took a dose of incoming today, but still seems to be generally within familiar bounds. The dollar is still something I'm holding on the long side, still short the pound, short the euro, although I trimmed back the Aussie because that seemed like it wanted to break higher. Still short a half of my Bitcoin short, so still have the risk-off side there, as well as in the S&P. Still a bit long silver, and this is that annoying crude oil position, which makes a little bit of headway today, but ultimately has 11 days until expiration and is going to be decision time on it very soon because it's frankly not getting there fast enough. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime. A show that I co-host with Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.